If you are a parent of a child who is under the age of 18 currently, or are a family who is planning or expecting a child to be born this year or over the next couple of years, this particular video is for you. In this video, we're going to be talking everything about Trump accounts, how they work, what they are, how they're considered for FAFSA, and what they become once your child turns 18 and over, and some strategies of how to think about that. Welcome to Elephant Corner Financial Lab. My name is Nev Kraguljevic. I am a financial planner with Elephant Corner Financial. And in today's video, I want to talk about Trump accounts. Now, you might have heard about these, and there is evolving components that are happening. So what I want to do is start a conversation about what they are, how to think about them, whether they should or shouldn't be part of your financial plan, and just really breaking things down a little bit for folks that might not be quite certain what they are, how they operate, and how to think about them. So let's change the screen a little bit. We're going to go to our whiteboard and really start talking about what they are. We're going to be talking about Trump accounts. Okay. So one of the first things to note is that they will become available on July 5th, 2026 and beyond. So once July 25th comes around, you'll be able to create these, and you can do that either on the website, which is going to be linked to the video below, where you can go check it out and read for yourself, or you can claim it on the taxes. Now, if your child is born in 2025, or will be born anytime between 2025 and 2028, you will receive an additional $1,000 from the US government for free. Okay, so that's kind of cool. That's sort of a neat little bonus that I think is important for folks to note and to keep in mind. Now, if, for example, you don't have a child that was born in 2025, or don't plan on having any more children from here on out, then obviously you're not going to be getting this $1,000. However, you can contribute $5,000 per year into this account. Now, these accounts, the way they're going to be set up, at least from what they're telling us right now, is they're going to be custodial accounts. So if you think about custodial accounts, would be like UGMA or UTMA, would be a good way to think about a custodial account. But basically, it's their account that you are just in charge of. There's some limitations of what this can be invested in. Predominantly, it's going to be in the low-cost ETFs that are based on the U.S. companies. We haven't really seen a release of specific ETFs that are going to exist. And my understanding is that just about every large brokerage firm that you can think of is going to have these accounts that are going to be rolling out in a few months from now. So things like Fidelity and Schwab and Vanguard and probably JP Morgan and even some banks are going to be having these accounts. So again, nothing to do right this second, but more to think about into the future as they roll out. Now, this $5,000 piece that we talked about is going to be per year. And this can be contributions that you make. This can be contributions that the grandparents make, that maybe aunts and uncles. So it's a combined $5,000 that is going to be per child. Okay, and this is going to be per year. There's also a stipulation that says that a business or an employer can contribute up to $2,500 into these accounts, but that goes towards this $5,000 max. So, for example, if you're employed with a company and they roll this out for all of their employees as a benefit, which we might see, then you would be contributing $2,500 on top of that to reach that maximum of $5,000 per year. My understanding is that this is going to be adjusted for inflation as the years roll around, but for right now, it's maxed out at $5,000. Now, this goes only until the year in which the child turns age 18. Once they turn into age 18, this then transitions into a traditional IRA. So that's kind of how it's going to work. Now, a couple of things to note and to really talk about is that when you contribute $5,000 into these accounts, they're going to be growing tax-free. So whatever interest and dividends and growth there is, it's going to be a tax-advantaged account. However, you won't get a deduction on the taxes for it. So, for example, let's put it into perspective of some of you might watching might be business owners, and you have heard about the whole idea of like maybe hiring your child, having them work in your business, and then you can contribute towards their IRA or Roth IRA. And if you contribute towards the IRA, then you can deduct the contribution that goes into their account and can deduct the employee expenses. This, you can't do that, but it will grow tax-free. Now, obviously, as I mentioned, once they turn age 18, it basically will function just like traditional IRA. So that means if they need to take money out before 59 and a half, there's going to be ordinary taxable income plus the 10% penalty. It's almost like a non-deductible IRA, if you think about it, which some folks do, and some folks end up turning into the backdoor Roth, which is going to be a video that we're going to be talking about in the upcoming weeks. So please stay tuned for that. So that's kind of where the idea is. $5,000 goes in. Now, once the child turns 18, then the question comes in, which we haven't received exact how this is going to play out from Department of Ed, but as long as custodial accounts, right? Like how does FAFSA look at this? So custodial accounts are seen as the student asset. If you have watched one of the previous videos where I talk about the FAFSA and preparing for all of that, then you will also note that anything that is a student asset has a much higher percentage applied towards or against their SAI and reduces it drastically. So that's kind of how it's going to be seen as long as it's a custodial. The IRAs, the retirement accounts for parents and for students, are not even considered for FAFSA. So there is a potential strategy. And again, we are waiting to get more guidance from Department of Ed, from the FAFSA folks, from IRS, from Treasury, and so on. But based off of conversations they have shared is that once that child turns 18, in the year in which they turn 18, you no longer can contribute. And it turns into IRA, as in it's potentially treated as a retirement account for FAFSA purposes, which means it will not count, which if that happens would be very, very cool and very beneficial, as long as your child turns 18 before the whole FAFSA and application and going to college and everything else. If not, then there might be a year where there's a higher contribution from the parents and the family and lower higher SAI, basically. So lower amount for aid from the schools. So let's assume that you have a child who is 10 years old. And so that leaves us with 8 years that we can contribute at $5,000 per year, which gives us $40,000, if I get right correctly. So gives us $40,000. Okay, now on the surface, this doesn't feel like a whole lot of money, and I will agree with that. However, let's then switch to the compound interest calculator. And in this calculator, let's go ahead and put in this $40,000. And we're going to, right, because once they turn 18, let's assume they do not contribute at all into this account. You won't be able to contribute anymore. And let's assume that the account is going to be invested for 50 years. So for 50 years, right, they're not adding anything into it. It just sits into the account and it grows. 50 years basically gives them to age 68, and most people tend to retire right around 65 to 67, so 68 is within that range. And let's estimate 6% interest rate. If it compounds annually, which most of the accounts would, we are looking at about $736,000 that you would have contributed to this child's account. Now, this is pretty cool and pretty awesome. If, for example, let's say that they would continue to contribute into this account $50 a month, right? Nothing more, just $50 a month. All of a sudden, we are looking at nearly $1 million that is in the account, so $911,000. If they get lucky and the markets end up working really well and we can potentially improve some of these investments, let's say that they get 8% return, right? So a bit more aggressive account. Now we're looking at $2.2 million that they would potentially get. This is huge and really important. And so this is where we can start talking a little bit about some of the strategies with this. Number one, if you only think you were to do is put $5,000 into these accounts and then they transfer and become traditional IRA, and you and the child do not touch it and just basically let it grow, we're looking at $700,000 plus minus, again, depending on the return that they can get. If they end up getting a little bit better return, obviously they get more money, lower return, lower money. And if they are able to then continue contributing, assuming right at the age of 18 and maybe a little bit less than that, they're going to be contributing about $50 a month, not a whole lot of money. They are looking at a very nice retirement egg. Now, one of the strategies that I think are important to talk about is what potentially happens if we can get this amount of money. So say that you are contributing it and now they turn age 18. Let me change the color of my pen. So now they're age 18, okay? And basically you can now contribute $0, but you've contributed 40, and let's assume that there has been some growth, and now we're looking at, I don't know, let's say $80,000. Okay. But let's assume that it's $80,000 now sitting in the traditional IRA. What we could do potentially, and again, you want to be very careful with this, especially if we're starting to talk about and think about FAFSA and the impact of it, is to start looking at Roth conversion. And the way that the Roth conversion for this account would work, which, by the way, before I get to that, let me just briefly explain. I'll make this a little bit smaller so there's room to grow. So the IRA is basically what is known as the tax deferred account, meaning you don't pay tax now, but when you pull money, it's going to show up as ordinary income. The Roth component is what is going to be basically tax-free. So you don't get the tax break, but it's going to be growing tax-free, and when you take it out, it's going to be tax-free withdrawals as long as it stays in the account for at least 5 years post-conversion / contribution. Now, piece to understand with the Roth conversion is that there is a proportional rule, right? So this $80,000, when you convert it, is going to have an ordinary income tax. Now, that is not going to come at your tax level. This is going to come at their tax level. So we are assuming that the age of 18, 19, 20, 21, they're probably in college. And if they have a job, it's probably that minimum wage, low paying employment. And they're probably not working a whole lot of hours because if they're a full time student, they probably can't be full time student and full time employee. Well, I know some people that have done it, but most of the individuals won't do that. So they might have some very, very small income and low income, and we can leverage the tax brackets that exist to roll over the course of time some or all of the IRA or the Trump account that became IRA into a Roth IRA account. Now, again, as I mentioned, when we do that, there is an ordinary income that will show up on their tax return. And when it comes to FAFSA, that is going to be seen as taxable income as their AGI, and as such is going to affect SAI. So we want to be very, very careful. The other piece that we might not necessarily want to do the entire 80,000, so we might want to do just up until they can get that standard deduction so that they don't have to pay many taxes or any taxes whatsoever. And so we can actually look at converting a small chunks over the course of 4, 5, 6 years. And now we can put in this 80,000 is not going to be 80,000, especially if we're paying taxes out of it. But there might be other ways to kind of look at it and move these funds into the Roth. If they move into the Roth, then when we looked at those returns that ranged anywhere from three-quarters of a million all the way to like $2-3+ million, that means that they will have tax-free funds that they can use in retirement without having to do much of anything. Now, this sounds all very exciting. I'm actually very excited about it, and I think it's a very cool strategy that can be executed. You just have to be very careful about it. But what it does, it opens up a lot of opportunities for the parents. Up until this point, only the parents who had small businesses where they can employ their children had this opportunity to contribute to their retirement accounts and Roth accounts and really start this, I call it legacy planning. I know most folks don't think about it that way, but as parents, we often want to leave some money to our offspring, to our heirs. One of that is done with estate planning and legacy planning. The other way to do it is to start slowly contributing over time into your child's accounts that are protected from taxes and tax sheltered and tax beneficial to them. Along the way, hopefully you're teaching them some good financial literacy lessons and helping them understand of why they shouldn't touch this, because obviously if they take it out, then there's nothing to grow and there goes everything. So hopefully you're teaching them, but this opens an opportunity for every parent to start slowly transitioning funds out so that when it comes time for your own retirement, you don't have to worry about, oh, well, am I leaving enough to my heirs? It doesn't matter because you've already pre-funded their retirement, pre-funded their lifestyle, pre-funded things for them. And of course, you can still do additional on top of that. But this really opens a whole new world of opportunities and possibilities for families, for kids, and really some of the strategies that exist. Now, you might be thinking, okay, well, if I am a business owner, then just continue with the Roth and traditional component that I've been doing. And if I'm not a business owner, then I'll just do Trump accounts. And what I'm saying is that if you're a business owner, you have access to both. So you might be able to do still some of that Roth that you've been doing with your kids and employing them and using their lower tax brackets, as well as Trump accounts. Now, one of the pieces that folks with the businesses have been like, ooh, maybe my business can contribute and it becomes tax deduction. Again, we're waiting for some of the guidance, but as of right now, you cannot kind of be involved with it. It doesn't work that way. It has more to do with like, I am not a control person whatsoever, and this is happening. So it's not necessarily set up to allow for your business to contribute to it. but we'll see what the regulations are, because over time they might change that. So it's definitely something worth looking at. This to me is one of those really exciting components about understanding what the new developments are and how we can use it to our benefit. So while I'm not necessarily, wasn't really crazy about these accounts when they first rolled out, as I started looking at the guidance, as I started looking at what are some of the possibilities and opportunities and options, and what do these accounts become later down the line, I definitely saw some benefit and opportunities that folks can leverage. Now, unfortunately, if you are a parent who has a child who will be turning age 18 in 2026, you unfortunately cannot participate in this, because the cutoff is in the year in which they turn 18. You cannot contribute. So whether they turn 18 on January 1 of a particular year or December 31 of a particular year, in that year you no longer can contribute. So technically speaking, you can do it in the year that they're born, all the way up until the year that they turn 18. So if you are in that spectrum, if you do have children that are under the age of 18 and won't be 18 in 2026, you have an opportunity to at least put $5,000, if not much more than $5,000, into these accounts. Now, again, as I mentioned, you won't get any tax deduction for doing this. It's sort of like think about it as a different component. Instead of doing a traditional custodial account for your child, you're going to putting it into this account that is going to be beneficial to them. Now, should you just do one or the other? Again, it depends what we're trying to save for. The traditional custodial accounts like UGMA and UTMA, they free up and become their accounts when they turn age 18 or 21, depending on the state where they're seen as age of majority. And then they can use it however they want, and it's fully taxable. This one, they can't really use up until 59 and a half. So it's really a retirement fund. You're really pre-funding their retirement account for well in advance. If this is something you said, well, I want them to have it for their wedding, then UTMA or UGMA account might be a little bit better option. Or you can just save it in your own brokerage account, for example, and then just gift it to them when that time comes. If you are saving for college education, then 529 plans are still the absolute best deal that there is. Depending on the state you live, you might be able to get some tax breaks. The accounts will grow tax-free, and as long as it's used for educational cost, it is tax-free withdrawals. If it's used for other things, then we're talking penalties. So I think it's really understanding of what are you trying to save for, where exactly in their life are you trying to benefit your children, and then act accordingly. Nothing says that you have to pick one or the other. You can actually pick all of them. You can have a 529 that says this is going to be for their education. You can have a custodial account that says this is going to be theirs to do whatever they want, whether it's for school, house, wedding, travel, starting a business. It's theirs to choose whatever they want to do with it. And I also want to pre-fund at least a portion of their retirement and help them along the way. You can do all of that. When it comes to FAFSA, 529 is going to be seen as a parent's asset, so you don't have to worry about that. The retirement accounts are not counted at all, at least as the rules stand right now. And custodial accounts are penalized the highest. They are seen as the student asset. So again, I think that there's a combination of things that can be done. It just matters, just a matter of what you're trying to accomplish and what you're trying to solve for. If this is something that is interesting to you and you're saying, oh boy, like I have some things that I think that this would be really cool, which by the way, I think that this is something that could be very, very cool, where we could really help our kids out financially and set them up for future really well. If you're looking for a thought partner to help you along with it, there's contact information and links down below, and I invite you to come and chat with me. It's a 30 minute to 60 minute free chat where we can just talk about your strategies and see if there are things that we can do to help you out. So hopefully this is something new that you have learned. Hopefully you got excited, got some ideas, got inspired, and I am excited for you. Until next time, stay money blessed.